Okay, we'll continue with the balance problems in leasing. So we had started with one problem under leasing wherein we have seen, so from a lessee evaluation point of view, loan versus leasing. Let's do one more problem. Go through question number 2. Go through question number 2. Go through question number 2. Okay, now if you look at this question, we have to again do an evaluation whether for go with the loan option or a lease option. Let's first start with loan option analysis. Working note 1, evaluation of loan option. Evaluation of loan option. Now I don't want you to write anything, listen for some time. What I did in the previous question, I'm going to do the same stuff, then later on tell a shortcut of what can be done. Please listen for some time. Evaluation of loan option. Now the question says that this guy is going to pay 1,78,858 at the beginning of every year. They have given the installment amount and the loan amount is something which we have to calculate. Now please listen. See, this is what I did in the last question. Annual installment is equal to loan amount by PVAF 13%, 3 years. In this case, the annual installment is 1,78,858. I don't know the loan amount. I'm going to try to calculate that. The PVAF is, what is the interest rate? 14%. How many years? 5 years. Now please listen. It is not paid at the end of the year, it's paid at the beginning of the year. So when you pay at the beginning of the year, you cannot take a normal annuity factor, because what is going to happen is 1, 2, 3, 4, 5 is what we normally take if it's the end of the year. But in this case, 1, 2, 3, 4, 5 will not be, it will become 0, 1, 2, 3, 4. So what you will do is PVAF 14%, 4 years. And plus 1. Can you tell me 14%, 4 years plus 1 is how much? 3.9137. Loan amount is our balancing figure, and this figure is 1,78,758. Loan amount is 178,858 into 3.9137. So basically I'm going to take a loan of 6,99,997 at the beginning of the year. 6,99,997. I don't want to write anything. After this we'll have to prepare something called as a loan amortization table. Loan amortization table is to be prepared. In this case it will start with year 0. It will start with year 0, and I'll take the figure as 6,99,998. Why I'm taking 998 is 24,998 is a salvage value. So if the rounding of issue is not there, it will happen to be 6,99,998. That will be the cost of the asset. So let me take that. For a single day there is no interest, and immediately you pay the principal. Immediately you pay the first principal. It starts with year 0, and immediately I pay the first principal, and I get my closing balance as 5,21,140, and thereafter it goes on like this. 521,140 is the closing balance. I charge interest at the rate of how much? 14%. Installment will be 178,858, and our closing balance of loan is this. This becomes the opening balance. This is the interest. This is the principal, and this is the closing balance. We reach a zero value. We reach a zero value. Any doubts in this? This is the structure. I don't want you to write any of this. Clear? After this, what you do is year, installment, interest, tax benefit on interest, depreciation, tax benefit on depreciation, salvage value, net cash flow, PVF, DCF. Exactly same as what I've done in the last question. I'm going to do the same thing, but it will start with year 0. 1, 2, 3, 4, 5. Installment is paid in advance. Any doubts in this? Interest is for year 1, this is the interest. The interest is this for the year 1. I'll have to take whatever is the interest there in that year. Tax rate is how much? So you get a 40% benefit on this. Tax benefit on interest. Depreciation is 6,99,998 cost of the asset minus salvage value divided by 5 years. Cost of the asset minus salvage value divided by 5 years. 1,35,000. 5 years depreciation is provided. Tax benefit on this is 40%. Salvage value at the end is 24,998. Asset would have been fully depreciated. So asset would have been depreciated by the right amount. So you have 24,998, and finally my outflows is installment, tax benefit on interest, tax benefit on depreciation, and salvage value. What is the annuity rate? What is the discount rate? After tax cost of debt. The discount rate is after tax cost of debt. Can you tell me what is the after tax cost? So 1.084. This is the outflow of the loan option. 4,69,945. This is what you have to do in a normal way. Now please listen. In this question, I'm not going to do this. Any doubts on this calculation? 24,998. Salvage value is 24,998. Book value will also be 24,998. No tax payment, no tax saving. So salvage value is equal to net salvage value. We have calculated depreciation considering that salvage value. Now this answer is 469,945. Now please listen. Calculation of present value of loan option. Interest you get tax benefit, depreciation also you get tax benefit. You can add and do it together. You can club it together. Particulars, amount. Particulars and amount. Now please listen. In this question, I'll tell you the shortcut, and when we use the shortcut, I'll also tell you. Cost of the asset. Can you tell me the cost of the asset? 6,99,998. Cost of the asset is 6,99,998. Second thing, less present value of salvage value. Present value of salvage value. Present value 24,998 into the factor for the 5th year is 72424. So this is the present value of salvage value less present value of depreciation shield. Depreciation shield. Shield is basically tax benefit on depreciation. Every year you have 54,000 ka tax benefit. 54,000 tax benefit into 5 years factor. This is the 5-year factor. Is there something which we have missed out? No, ideally both numbers should match. Just give me a minute. Cost of the asset is 6,99,000. Which one?
Salvage value, what are your bid?
No, that is right, no?
6,681 only you should take. You took 724.
No, I didn't understand.
The present value, salvage value.
Hmm.
You took 0.724.
This one. So now when can I use the shortcut? Is last question we did a detailed way. Whenever the discount rate is the same as after tax cost of debt. If you read the heading of the question, discounting rate same as after tax cost of debt. And the earlier question which we said, discounting rate different from after tax cost of debt. Now if it is different, then you will have to do all of this, loan amortization table and the cash flows calculation. If it is same, I don't want you to do anything. Institute doesn't provide this answer, but this is what you need. Just 4 lines. You need not write anything beyond that. Write 4 lines and your answer is done. 4,69,944 and 4,69,944 exactly matching. So you don't have any difference in the answer. So whenever the discount rate is same as after tax cost of debt, cost of the asset is the first item. Second item is present value of salvage value, present value of depreciation shield. Now why is this matching? The reason for this matching is what you write as installment and interest put together, the present value of that when you discount at 8, see, I take a loan of 1 lakh and if I pay interest at the rate of 10%, so let me take a loan of 1 lakh and I'm going to pay interest at the rate of 10%. So 10,000 in the first year, 10,000 in the second year, 10,000 in the third year, 10,000 in the fourth year and 1,10,000 principal payment at the fifth year. If I have taken interest at the rate of 10%, 1 lakh loan, and if I am going to discount this at 10% itself, taking loan at 10% and discounting it at 10% will give you back the value of 1 lakh itself. So when I have taken my loan at 14%, and if I am discounting it at the same 14%, I didn't take a loan at 14%, basically 8.4%, and if I discount at 8.4%, it doesn't serve any purpose. All these are useless things to do. So we are not going to do any of this. We are just going to write 3 items, which are cost of the asset, present value of salvage value, present value of depreciation shield, and that ends my question. That is as far as loan option is concerned. Lease anyway the normal way of calculation. So the point is, if the discount rate is same as after tax cost of debt, the things are far simpler for us. If it is different from after tax cost of debt, we can't do much about it. We'll have to do the calculation which I did in the last question. So year, opening balance, interest, repayment, closing balance, installment calculation, tax benefit, all of this has to be done. You are left with no option. Clear? Able to understand this? This is covered, I think, in the theory part. Go to the theory part. Page 18. Compute present value of borrow and buy option, purchase price, present value of tax saved on depreciation, present value of net salvage value, present value of borrow and buy. Interest rate is irrelevant because the borrowing rate and the discount rate are same. The appropriate discount rate to be used is after tax cost of debt. However, if the problem specifies different discount rate, then in between cash flows have to be calculated by considering the interest and installment payment. That is what we did in the earlier question. Earlier question, we ended up calculating so much. All of this takes a lot of time and we ended up doing this. In this question, I'm not going to do. So we are going to directly do this. I have done all this calculation to just prove the fact saying that if discount rate and after tax cost of debt is same, don't bother about interest, installment, tax saving, all of that. Clear? Able to understand this? Working note 1, evaluation of loan option. Straight away this calculation only. Working note 1, evaluation of loan option, particulars, calculation amount.
So only if the mention of WDV number, then it will be different.
Nothing. Doesn't matter even if it's WDV. What matters is discount rate. Last problem, the discount rate was clearly given as 12%. If the last problem, instead of 12%, if it was after tax cost of debt, last problem has one more issue. Your taxes are paid 1 year in arrears. So anyway, that is not going to work. If Last problem, the tax payment issue is not there and it's 9.1%. I need not do any of this. Straight away these 4 lines. Straight away only these 4 lines. Then you will have to do the detail. Then you have to do only detail. There it can't work. The point is why it is working here is when I pay 10%, immediately I get a 3% benefit. So 7% is my after tax cost of debt.
The same year you get the benefit.
Same year I get the benefit. So my cost of debt is the after tax cost of debt because every year it's going to remain constant. Whereas if it's 1 year in arrears, that's not going to work out. It is given in the question, no? Evaluate the two alternatives by considering after tax cost of debt. And if the problem is silent, it's after tax cost of debt. So the best thing for us is the problem should never specify a discount rate. If it doesn't specify a discount rate, things are far simpler for us. We will take after tax cost of debt and proceed with it. When the question specifies a discount rate, that's where a problem comes for us. Because if it specifies a discount rate, I will have to go through the detailed route. So particulars calculation amount. Okay, one calculation anyway you have to do. This cost of the asset calculation you will have to do. Particulars calculation amount, cost of the asset in bracket note 1. Particulars calculation amount, cost of the asset in bracket note 1, and show this calculation. How we got this loan amount? 6,99,998. The amortization and all is not required. Do this working note. This is to note 1. Calculation of asset amount. The important point is if discount rate is same as after tax cost of debt, don't bother about any calculation. In the practice manual, the answers will be different. One of the way in which they do will be different, but net your answer will match. Just some rounding of differences can be there. After calculating the loan amount, the other name for loan amount is cost of the asset. Which one? It has to be same, no? So then you take the cost of the asset, whatever it is. If they are putting their own money, what I need is the cost of the asset. We have considered after tax only, 8.4%. No, so my loan interest payment can't be, so my bank will charge me 14%. So if you do at 8.4%, you will get an interest payment at the rate of 8.4%. Then your loan amortization will not balance. So bank will charge 14%. Tax authorities will give me some benefit. So to bank I have to pay 14% only. To bank I'll be paying a higher amount in fact. I'm not discounting that. If I end up discounting what I'm paying to the bank, that amount is going to be far higher. What I pay to the bank is 14%. Tax authorities give me some benefit. So net it is 8.4%. So cost of the asset is this, less present value of salvage value, less present value of depreciation shield. One divided by 1.084. So for salvage value purpose, the 5th year factor is 0.668 and depreciation shield is we need not calculate how much is the interest payment, how much is the principal payment, all of that is not required. Any doubts in this? Then you analyze the lease. Lease option is simple. Loan is when it takes a lot of time. So loan, we will use this shortcut if discount rate is same as after tax cost of debt. Then analyze the lease option, year cash flow, PVF, DCF. Yeah, it's the same amount, no, every year. How much are we paying? Yeah, 25%. So 1 to 5 together. 1 to 5. 25% of 1 lakh. ठीक है. 25% of the cost of the asset. There's a mistake in this statement, okay? There is a mistake in the statement. You'll have to consider the tax part. Tax part has to be considered. Consider that and do it. Consider the tax part. So 1,75,000 is not a rental. It is 60% of 1,75,000. Post tax lease rental. Your lease rental is a tax deductible expense, so be careful about that. It is not 25% of the cost of the asset. Which one? Yeah, it'll obviously so. Your taxes are a very important decision. 25% into 7 lakhs or 6,99,998 into what is the tax rate? So into 0.6 into 0.6. Your expense is not 1,75,000, it's 1,75,000 into 0.6. It's 1,05,000. 25% of 7 lakhs, cost of the asset. 25% of 6,99,998. 25% of cost of the asset. 25% of the cost of the asset. Any doubts on this? Lease rental 25% of the cost of the asset. Clear, not clear? So you will have to consider the tax part. Be very careful about that. Tax part has to be considered. Your discount rate has to be after tax cost of debt if the problem is silent. So this problem answer is only in 6 lines, that's all. Loan is this much, lease is this much.
1,75,000, they'll pay every year.
Correct.
For 5 years.
Correct. So it's an annuity 1 to 5. Finally, you can write your decision. The decision is to go ahead with lease. The decision is to go ahead with lease. Now you tell me what is the answer to part 2 of the question. It has no linkage with this question per se. It's altogether a different question which I picked up from some place. Question 2.
Lease option value taken as
No comparison. That's right. This second part has no linkage with your earlier question. Calculate the annual percentage rate implied by the bank's offer with interest payable every 6 months.
taking asked us to base that calculation.
No. It's a very simple answer, but if you understand it, you will be in a position to do it. It was asked along with the lease arrangement only. Along with lease, this question was there. Okay, now please listen. Annual percentage rate is, what is the rate for a year? 14%. For 6 months, it will be 7%, and effective rate is 1 plus r the whole power n, 1 plus r the whole power n minus 1. That's all. So annual percentage rate implied by the bank's offer is 14.49%. If they ask me to pay half yearly interest, the annual rate which the bank is charging is 14.49%. Wait, this is one part. Second part is they are asking for installment. Your cost of the asset is 7 lakh. Tell me how much should I pay at the beginning of every 6 months. That at least you do it and let me know. Annual percentage rate is 14.49%. What installment is to be paid at the beginning of each 6 month period? Annual percentage rate is nothing but 1 plus r the whole power n minus 1. Effective rate of interest. 1 plus r the whole power n minus 1. What is the denominator you are taking? Just tell me that.
7% of 10 periods.
Beginning.
9 periods plus 1.
9 periods plus 1. It's paid at the beginning. 7%, 9 periods factor. So the installment is going to be loan amount divided by PVAF 9%, sorry 7%, comma 9 periods plus 1 to it. This is what we did originally here. PVA 14%, comma 4 years plus 1. Here it is not year, it is half year. So 7%, comma 9 half years plus 1. Any doubts on this?
So you're saying it's payable every 6 months.
Yeah, beginning of every 6 months.
It's paid in 2 sets of 6 months.
Correct.
So ultimately it will be 14% if I take 7 and 7.
No, so that's what now 7 and 7 when you pay half yearly, it is 14.49. If people tell me to pay in between, the effective rate goes up to 14.49. Why it goes up to 14.49 is the 6 month payment which you make 7%. On that, the bank would have earned interest of 7 on 7%, which is extra 0.49. So if somebody, see, whenever you invest in a bank FD, they'll always suggest what is the compounding frequency. That is also plays a part in our decision. Because if the compounding frequency is monthly, my effective rates goes up. If it's yearly, my effective rates remain the same. So similarly, if bank tells me to pay, see, when we go for a housing loan, they say the rate of interest is 8.75% per annum. It's not 8.75% per annum because we are required to pay every month. So effectively it's 8.75% divided by 12, that rate which you get, the whole power 12 minus 1. So effective rate will go up to something like 8.9 or 9%. Even it's 8.75% is what they suggest. But if I end up paying every month, the effective rate, that is, just a minute, let's take 9%. So 9 by 12, 0.75 is the per month rate. Effective rate is 1 plus 0.75%, the whole power 12 minus 1. Effective rate is 9.38%. So if bank says your housing loan is 9% and you have to pay every month, you are not paying 9%. You are paying 9.38%. So that is why if I ended up paying every 6 months, the rate is not 14, it goes up to 14.49. So if the bank suddenly says you have to pay every quarter, then rate further goes up. Every month, further the rate goes up. Why it goes up is because to make that payment, I need money from some source. So unnecessarily, otherwise, assume I had the money at the end of 6 months, what I would have done is I wouldn't have paid the bank. I would have created a FD out of it, earned something and then paid the bank. So effectively my rate comes down. So that is why if the frequency changes, your cost undergoes a change. So installment is loan amount by PVF. You can complete this. Please complete this. Annual percentage rate is 14.49%. 7%, 9 periods plus 1. So any problem on leasing, first check whether the discount rate is same as after tax cost of debt.
So explain the 14.49.
1 plus r the whole power n. 1 plus 7% whole power 2. 1 plus 7% whole power 2 minus 1. 1 plus r the whole power n minus 1. Effective rate of interest. 1 plus r the whole power n minus 1. Yep. Can you proceed? So now onwards, the first thing I'm going to check is the discount rate same as after tax cost of debt? Then only we'll do all our calculation. If it is same, problem is very simple. If it is different, then we'll have to do the detailed calculation. Clear? Any doubts on this? Let's proceed to question 3. Go through question 3. No. Let me just. I don't think so, but. I think you'll have to manage with the mobile phone. First check in the question, is the discount rate given in the question? No. Discount rate, cost of capital, discount rate, any word like that. The cost of capital is so much, the discount rate is so much, anything given? No. So the discount rate is going to be after tax cost of debt. We are not going to prepare a loan amortization table. We are also not going to do a detailed calculation of cash flows. So loan option, only three things: cost of the asset, less present value of salvage value, less present value of depreciation shield. That ends there. Now what is the use of these information? There is some gross revenue, operating cost. I can buy the asset for 44 lakhs, or I can take it on lease for 3 years. Some rental information is there. What is the use of this revenues, operating cost? Where do I factor this? Or I have to do a detailed calculation now because of this information. Okay, that's okay. What do I do with operating cost then? Will this form part of my cash flows? Not form part of cash flows?
I think gross time less revenue would be gross revenue less operating.
No, that's okay. So do I need to take this revenue in my analysis?
Yes.
Where?
Will it be adjusted in cost of the asset?
No, I'm asking you a question. So will it come in the cash flows? See, I have been telling for loan option only 4 lines we will write. Now, because of this information, do you want me to consider something more and calculate, or it is not to be considered? Okay, it will be ignored. I'll tell you why it will be ignored, because this will be earned even if there is a lease option or even if there is a loan option. So our objective is not to analyze on the profitability of the computer. When I have to analyze the profitability of the computer, then I'll have to do initial outflow. That is like a capital budgeting decision. Initial outflow is 44 lakhs. In between flows 45 lakhs minus this, 50 lakhs minus this 50. That is capital budgeting. We are not doing capital budgeting because the requirement of the question, you are required to evaluate whether to lease or buy the asset. I am not required to analyze whether this asset is required or not. Whether this asset is required, then that is important. When whether this asset is required, then lease rental is not important, because that is an irrelevant item, because either lease rental or interest, that is the next set of analysis. So my first set of analysis is whether the asset is good on its standalone basis, that we do in capital budgeting, assuming that has been done by the company, because I am not getting into that and all. So even if I buy the asset or take the asset on lease, revenue will be earned by me, operating expenses will be incurred by me. So in both the cases it is irrelevant. The only use of revenue, that is only revenue, is because to calculate lease rental. That is only to calculate lease rental, no other information. So why to calculate lease rental? Because lease rental is 10 lakh plus something. To calculate the lease rental, I am going to use the revenue, that's all. Nothing beyond that. Revenues, annual operating cost is of no use in this question.
Lease rental is going to be fixed irrespective of the revenue one.
Revenue? So the revenue is going to be same in both the options. Be it a loan option or be it a lease. So this building, if Bharadwaj Institute buys it or we take it on rental basis, the amount of fee collections which we are going to do is same. So whether I buy the asset or whether I take the asset on lease has no impact on the amount of revenue which I am going to earn. Now when I am taking it on rent, I can tell my landlord saying that I will pay you 1 lakh plus 10% of what I collect. So that is an agreement I enter into with my landlord. So that can be anything. It can be anything. So between buying the asset and taking the asset on lease, what are relevant items? Buying the asset means you have to take a bank loan. When you take a bank loan, you have to pay interest, principal. All those present value will add up to the cost of the asset. And on top of that, you will get depreciation benefit, you will get salvage value benefit. That is the purpose if you own the asset. If you take the asset on rent, only one thing matters to me, I pay rental, that's all. Why should I be bothered about what revenue I am getting out of this building? Because I am not evaluating whether, see, my decision if it was whether to set up, whether to put another academy in Kuti Street, if that was my decision, then what you say is correct. I'll have to consider revenue. I'll have to see whether I'm going to generate adequate amount of revenue, what are the expenses going to be there, is it viable to buy this building or not, that I can decide. Now the decision is not whether to take this computer or not. The decision is how do you take the computer. How do you take the computer? For that to be answered, I'll write only these things. Cost of the asset, present value of salvage value, present value of depreciation sheet, year, cash flow, PVF, DCF, whatever is the lease rental you pay. That's all. Nothing beyond this. I'm not.
Depreciation sheet comes only when you own the asset.
Correct. So that is for loan option. When you take a loan, it means you're buying the asset. So that's why loan option has salvage value and depreciation sheet. Both. Clear?
So will there be questions where they'll ask us to compare which option is better, whether taking it on lease or
Whether?
whether taking it on lease is beneficial or buying the
That is what we are doing now. Whether to buy the asset or take it on lease. So that is the requirement of the question. Clear? Now you do it. I've explained what are the things to be written. You will have to write those 4 items. You try doing it. Cost of the asset, less present value of salvage value, less present value of depreciation sheet, and that gives you what is the outflow for the loan option. Lease option, lease rental into the discount rate.
Yeah, please listen to the class. What is annual turnover? To the class.
Capture those 3 items.
Okay, turnover of 12 months utility at rate of per year. What is adjusted annual turnover? Increase in rent. Increase or decrease in rent will be given a threshold and it will be computed. Adjusted annual turnover. What is standard turnover? Okay, turnover of the period of inscription in the immediate preceding year. Okay, what is insurable value? Gross profit ratio, we just want on what? Yeah, yeah.
The discount rate is 8%.
If I compute, four percent, 4%.
minus 20 lakhs. Then do the lease option. If you're done with this, do the lease option.
Sir, what is gross profit ratio for loss of profit?
Depreciation each year is 8 lakhs. Tax shield is 4 lakhs.
That's good. Net profit is plus issued starting charges divided by sales into 100. How will you find out short sales? What is the basic standard turnover? Good. That's good. Minus actual sales will equal the short sales. Okay, loss of profit will be P ratio or into short sales. Okay, CP ratio into short sales will provide you what is the loss of profit. Okay, right now. Okay, can you tell us?
Now just listen for a minute. This is the answer we got, 1781 497. A similar problem is there in institute material, wherein it is half the values. All the values are half of what it is. Listen for a minute. Just for a minute. All the values are half of whatever is there in the question. Their solution will be like this only: installment, interest, net cash flows, and then finally that got 890 470. We would have got double of that because our figures are double of that question. 890 470 is what institute material says, and we have got double of that. Some differences, rounding off issues are there. So don't worry about how the answer has been calculated. You proceed and do it this way. Your final answer will match. This is how the solution will be there in the institute material. But important thing is, if the discount rate is same as after tax cost of debt, there's no point in calculating interest and principal. It doesn't serve any purpose. This is loan option, then lease option.
Answer match up, I think. 14 lakh 95% we got. Here they have written only 8 lakh 95.
So same, no? Divide by 2. 890 748. Theirs is 890 470.
Why do we have to divide by 2?
No, the question figures are double. It says purchase the computer for 22 lakhs. The question which we are doing is double of that. What is the year one rental?
5 lakhs. 10 lakhs rental.
10 lakhs.
10% of the
So 14 lakh 50, no?
after tax.
14 lakh 50 into 50%. 15 lakhs into 50%. And 15 lakh 50 into 50%. You'll have to consider the tax impact. Please be careful about that.
We are going to set up what are the steps. Step 1.
Issue payment of 12 lakhs.
Step 3.
Oh, there is another 12 lakhs, yeah?
Step 5.
Okay, additional payment. Okay. So I'll have to add another 6 lakhs to this. Plus 6 lakhs.
So what happened to the annual operating cost?
No use.
Is there a cost which we incur apart from 44 lakhs?
Nothing is given. So if something is given, we'll consider. Nothing is given, we'll leave it. There can be some repairs cost and all if it is given.
They're saying it's an additional cost of 2 lakhs startup and waiting at
So then next line. These costs are to be borne by the lessee in case of lease arrangement. Lessees. So if I buy it or I take it on lease, I'll have to incur this. So it doesn't matter. Can you proceed? Sure, sure. Whichever is better, yeah. Loan option will be better.
This question itself, lender's point of view, whether the income generating plan is
We'll come to that. I think we have one question on like that. Just a minute. No, so I think that is there in. No, I don't have any question on that. Let me just see if I can add a question. November 2018. November 17. Okay, let me just see.
residual question I'm thinking. That both are there.
Okay.
That is there in practice one only. So practice number 4.
Okay, let me just see.
Same question.
Can you proceed? Go through question number 1. Question 1. Okay, in question 1, they have given details of 2 codes. So it's not a lease versus loan. Evaluate code A separately, code B separately. We are required to find out both are lease option only. So year, cash flow, PVF, DCF. How much outflow is in code A? How much outflow is in code B? Evaluation of code A. So when you start, you will have to pay some amount they are saying, and thereafter every year you have to pay some amount. Not kind of down payment, it is a one-time rental payment. Yeah, you can consider it as an initial payment. Correct. Evaluation of quote 1. Outflow only. Evaluation of quote 1 or quote A. Year, cash flow, PVF, DCF. Year, cash flow, PVF, DCF. Year 0, how much we pay? 5 lakhs. Not an inflow, no. That's a machine. I am thinking of which option to choose. Value of the asset is 50. Where can it be used? If they give me a loan option analysis, I can do a loan option with that 50 lakhs. Year 1, how much? Arrears means at the end of the year. See, payable in arrears means at the end of the year. Payable 1 year in arrears means next year. Normally we pay in arrears only. So all payments happen in arrears. If something is in advance, then again a problem. Year 1 has to be written as year 0.
So in that case, won't arrears be year 2?
No, so payable in arrears, normal understanding means it's at the end of the year. So instead of using the word payable at the end of the year, they've used the word payable in arrears. So they could have used the word payable at the end of the year. Both serve the same purpose. Payable 1 year in arrears. When we did the tax problem, so that 1 year in arrears is needed here. So here it is payable in arrears. What is that payment?
21 plus.
Anything else to be considered? Tax on not 21.06 minus 0.3 into 26.06. 0.3 into 26.06. Why 26.30% no tax rate? Yeah. Why 26.06 is that 5 lakh ka payment also you will get the tax benefit. So 5 lakh will go to my P&L. 21.06 will also go to P&L. So on that 26.06 I'll get a 30% benefit. Then year 2 year 3 directly straight away I can write the after tax figure. So year 1 21.06 minus 0.3 into 26.06.
Why can't we adjust that 30% and leave it 0?
So there are two ways in people consider. One, people say that when you pay immediately, you immediately get the tax benefit. But the other way of understanding is only at the end of the year we get to know tax liability. So most of the times people end up paying taxes only at the end of the year. So if at all there was an initial lease rental paid, the benefit of that would have come only at the end of the year rather than coming at the beginning of the year. So that is why most of the institute answers will be at the end of the year benefit. But a lot of people argue saying that we have a provision of advance tax payment and all. So because of that, we should also consider at the beginning of the year. So if that was the case, I would have straight away written 3.5.
But doing that is the wrong method.
At least in our solutions, nothing is there. So preferable to do it this way itself. Use the factor as given in the question itself. Oh, sorry, my mistake. 3 years, no quote A. Quote B is 4 years. For year 1 to 4, those factors are. Year 0, the factor is 1 only, not always.
Year 0, that's wrong.
What happened? Then do quote B analysis. I'll come to it. There is something else to be considered. Complete code A, code B. I'll then tell you one more concept which I should have done in capital budgeting. We are yet to do that, so I'll explain it here. Completed code A, code B. Done? Okay. Now after this, just a minute, particulars. I'm just noting down the stuff and then I'll tell you to write code A, code B, present value of outflow. Code A was 40.34 lakhs, code B is 44.35 lakhs. Life 3 years, 4 years. Now though code A is lower, but it has a life of only 3 years. That means I can use the asset only for a period of 3 years. Whereas code B says the life is 4 years. So I'm going to use the asset for 4 years. So it is not I'm paying less in code A. I'm paying 40 lakhs for 3 years and 44 lakhs for 4 years. If I take this into context, which looks better? 40 lakhs for 3 years or 44 for 4 years? 44 for 4 years looks better. We don't go by that. Now I'll tell you what you do is EAC, equated annual cost, which is nothing but present value of outflow divided by annuity factor. So present value annuity factor in brackets R comma life. This will be done when I do capital budgeting. R comma life. So for quote A, the annuity factor is 3-year factor, because it has a 3-year life. So 3-year annuity factor is the total of these three. For quote B, it is 4-year annuity factor, which is this item 2.49 and 3.17, and the equated annual cost is, I end up paying 16.20 lakhs per year and 13.99 lakhs per year. Between these two, which is beneficial, I'll go ahead with that. I cannot go by present value of outflow because life is different for both the projects. So we go by equated annual cost, 16.20 lakhs and 13.99 lakhs. Clear? Next, calculation of EAC. Calculation of EAC. Your conclusion will be based on lower EAC. Can we proceed? So your conclusion is the company should go ahead with quote B as it has lower equated annual cost. Now I'll do this question 5, which was pending in the evaluation of LESA. Go through question 5 now. The earlier question 5. Okay. Now they are asked us to calculate lease rental which will make the firm indifferent to the loan option, and thereafter certain extra analysis is required. Making firm indifferent is present value of loan option should be equal to present value of lease option. First question, is the discount rate given in the question?
Cost of capital.
How much?
12%.
8, no? This question 5. Earlier. So your cost of capital is 8%. Is it different from the after tax cost of debt?
Because interest is 10%.
If it's different, then we will have to start with a loan amortization table. We'll have to start the question with a loan amortization table. Now in this question, the loan is 5 lakh rupees, and how are we going to pay?
Equal annual installments paid annually.
Read carefully, read that line fully. Principal amount will be paid in 5 equal installments. So it's not equal installment in short. It's only equal principal. Equal installment means every year you will pay the same amount. Equal principal means principal will be 1 lakh and interest is going to be whatever is the balance based on that. Clear? Able to understand this? This is equal principal and not equal installment. If it was installment, we will have to calculate that. Working note 1, loan amortization table. Loan amortization table.
Page number 12, November 2016. Page number 12, November 2016.
Loan amortization table. Year, opening balance, interest, principal, closing balance. I am not writing installment, I am writing principal in this case. Year, opening balance, interest, principal, closing balance. Year opening balance, interest, principal, closing balance. Start with year 1. What's the amount of loan we are taking? 5 lakhs. 5 lakhs is the amount of loan taken. Interest is 10%. Principal will be 1 lakh. 5 lakh divided by 5. No adding interest and subtracting it, because if I add interest, I'll have to show interest payment also. So my closing balance is opening balance minus principal. Earlier it used to be installment which included interest. So opening balance minus principal is closing balance. We'll have to complete this for 5 years. Opening balance, interest, principal and closing balance. This week you'll have a class on Tuesday, Thursday. That should be fine, no? Tuesday, Thursday. Next, working note 2, calculation of present value of loan option. Calculation of present value of loan option. Now let's first freeze the rows to be columns to be captured, and then we'll start capturing it. Calculation of present value of loan option. It starts with year. What is the first thing we capture after year? Let's discuss that. We capture not lease rental, loan option. Installment we capture. So please listen. I'm not going to capture installment. I'm going to write principal, interest, principal and interest, tax saved on interest, or let me club it with depreciation. I'll club it with depreciation, right? Principal is one outflow, interest is one outflow, depreciation, tax saved on interest and depreciation, tax saved on interest and depreciation, salvage value and net cash flow. Net cash flow is nothing but principal plus interest minus tax saved on interest minus salvage value, or plus tax saved on interest if you are writing a negative number there, whatever way you want to do it. Basically tax saved on interest and salvage value will reduce the amount of outflow. Interest, I'm not, last problem it was installment, so principal and interest got clubbed there. In this problem we are doing it separately. So principal, interest, depreciation, tax saved on interest and depreciation put together, salvage value, and you get the net cash flow. After net cash flow you have PVF, DCF. Clear? Do this. Read it carefully. The machine will be fully depreciated over its effective life.
But we have salvage now.
But they have said fully depreciated. What to do?
So 5 lakh you have to say.
The machine will be fully depreciated, so it's 5 lakh by 5. The machine will get fully depreciated. The salvage value is 35,000 because on 50,000 you will pay tax. Book value is fully written off. Any doubts on the loan option? Now they are asking, tell what lease rental is to be fixed so that lease option and loan option you are indifferent. How do we do this?
We did with indifferent.
Yeah.
Total amount of
Yeah, so your lease rental outflow should also be 343,807. So working note 3, calculation of indifferent lease rental. Calculation of indifferent lease rental. Indifferent lease rental. Indifferent lease rental. Year, cash flow, PVF and DCF. Year, cash flow, PVF and DCF. It's an annuity structure 1 to 5. The only thing which I know is the total should be 343,807. 343,807. So this also has to be 343,807. The factor is 3.993 and the lease rental is I would want the outflow to be 343,807. Outflow has to be 343,807. So what is the lease rental? No, incorrect.
86,109 into tax.
Divide by tax. Divide by 1 minus tax rate. So lease rental is divided by 1 minus tax rate.
Because this is after tax.
This is after tax. 86,109 is your after tax figure. So the rental is 1,23,012. $86,109 divided by 1 minus tax rate. So if they fix a rental of 123,012, everything is worked fine. Any doubts in this? Now second part they are saying, no, the other guy is saying 1,20,000 is the rental he is going to fix. Tell me how much interest rate should I reduce? Interest rate payable, which will make the firm indifferent to the loan option if the lease rentals are 1,20,000. So the lease rental is not 123,012. Lease rentals are going to come down. If lease rentals come down, lease will look to be better than the loan. But they are saying we can reduce the interest rate. So we are required to answer what should be the interest rate. First let's calculate what is going to be the rate. Any doubts on indifferent lease rental? Working note 4. Calculation of present value of loan lease option. Rental of 1,20,000. What is the rental we are paying now? So 84,000 after tax. Be careful about that. After tax. So 3,35,388 is what I will pay in case of lease option now. Interest rate payable, which will make the firm indifferent to the loan option. Any doubts on 335, 388? Now please listen. We are paying 335 388, but the requirement is, sorry, we are paying 343 807. We have to bring it down to 335 388. Now this 105 which I am writing here is principal of 1 lakh plus interest of 35,000, net interest, let's take it as 35,000, minus depreciation benefit of 30,000. 1 lakh plus 35,000 minus 30,000. Now in this thing, what is going to undergo a change is, you don't know interest. Interest rate is X now. Interest rate for the time being is X. So please listen. Principal is 1 lakh for all the 4 years, all the 5 years. Interest is for the first year 5 lakhs into 0.7x into 0.7x. Why 0.7x is? X is the interest rate. X is the interest rate. So X is the interest rate. After tax, you have 0.7 interest to be paid. X. So finally, X can turn out to be 0.08. Then in that case, 5 lakh into 0.08 into 70% is our interest outflow. So 5 lakhs is the principal and interest is 0.7x. So my interest is 3 lakh 50,000 X for the first year. X is the interest rate. Second year 2 lakh 80,000 X. Third year 2 lakh 10,000 X. 1 lakh 40,000 X and 70,000 X. This principal is outflow, interest is outflow. Depreciation is a benefit. Tax benefit on depreciation is 30,000. How 30,000? 1 lakh into 30%. And there is a salvage value which I receive in the 5th year, which is 35,000. The total of all of this is net cash flow.
That should be equal to 335.
No, into PVF will be equal to, you'll have to multiply.
The total of DCF will be
Total of DCF. So PVF, DCF, PVF and DCF. Now please listen. My net cash flow is this plus this technically. So for example, though you are going to calculate this, assume if I had my earlier problem of 10% tax rate. What was the interest rate originally? 10% interest rate. Then this figures would have been 3,50,000 into 10%. So 35,000, 28,000, 21,000, 14,000, 7,000. This is today's scenario. This is today's scenario, and my net cash flow was this plus this minus this minus. It will match with the NCF which you have written in top. So I have built the same structure. We have built the same structure in a little different way. Can you solve this? Add all of this, that is NCF, put PVF, get the DCF total and equate that to 3,35,000. 3,35,388. So above this you can write, let us assume X to be the interest rate. Let us assume X to be the interest rate. get the PBF, DCF, and then yeah.
Depreciation of salary will be
Depreciation salvage
will be outflow.
will be
Outflow.
inflow. Negative. Well, net you will have to subtract it. Yeah.
What is the sentence? Due to increase in working capital. Okay? Okay, for the class in property, take 30,000 into 20%. Work. Reduce the turnover avoided due to increase in expenses. Because of increase in expenses, I was able to avoid 30,000. It is not reduced turnover. It is not reduced turnover. If you have stopped with the word reduced, that's what I was telling you. The word avoided is only factor. Yeah, this is avoided. That's what I want to say. This is avoided. This is avoided, my dear friends. Had I not incurred that, it would have been 37,500. Because of incurring it, it became 67. This is what is avoided. That's what I also say to you. But you are saying that this is the amount of. No? You cannot. Okay. Your plan is right. As of now, let's not find out. As of now, let's not find out. I also try to bring up practice manual. I don't think you all have practice manual. There is something practice manual from the last time I have to take it. After the exam, okay, we have two answers. That's what our friend says. One of the answers is 28,125, where they have taken 30,000 into 20%. The other answer is 29,250. Okay, keep it open. Okay, keep it open. Probably we'll find the answers. Okay, keep it open. Nothing wrong. Keep it open. I'm taking you to the next slide. November 2010 question. I'm taking you to the next slide. November 2010 question. November 2010. A trader intends to take a loss of profit policy with insignificant 6 months. However, he cannot decide the policy amount. Turnover in the last financial year. Standing charges in the last financial year. Net profit earned in the last year, 10% of turnover, and the same is expected in subsequent year. Increase in turnover expected 25%. To achieve additional trade sales, trader has to incur additional expense. My dear friends, a question of this nature is also possible. That is asking you to find out what should be my insurable value. Asking you to find out what should be my insurable value. A question of this nature is also a very possible question. In which case you should not worry about claiming. You should go and find out what should be my insurable value. My insurable value should be.
What is the rate?
9.045%.
Could be just a minute.
Into GP percentage.
Loan is 255,669. This lease was So 881379x is equal to 335388 minus 255669. X is equal to 79718.
Right? For example, in this question, 90,000.
9.04%.
To fail to achieve additional sales. That is the turnover growth of 99%. To achieve additional sales,
So if the fixed interest rate of 9.04%, we are fine with it.
What is 10? I'm getting 10%.
You can't get 10%. You are equating it to what number?
8800.
No. Equating it to?
3.38.
That will be 10% only. No, that was the original scenario. If you put 343, then you are revalidating what you done was right. That is what I was about to say. In this place of x, if you put 10%, you will get the original amount. Original was this 343,807. Because this was at a 10% interest rate. So if you substitute and you get 343,807, it means you have done it correctly. The calculation. But you will have to equate this to 335, that number. So the interest rate is 9.04%. So if the fixed interest rate of 9.04% and lease rental of 1,20,000 both are equal. Clear? Next they are saying, okay, interest rate can't be changed. Okay, completed the interest rate part.
estimated increase in standing charges.
How much? 7,715?
3353. So you are equating this. 25667 plus 881379 is equal to this. So 335,388 minus 255,669. 335,388 minus 255,669.
1,21,250. Present profit 45,000. Present profit 45,000. Payable. CP ratio is equal to 45,000 plus.
Clear? Now next thing they are saying, we cannot change the interest rate. Tell us how much should the residual value be so that both are equal. They want us to change the residual value. How do we do this? They are going to change the interest rate. The residual value can be changed. What should be the residual value? They are asking.
What is the residual value? Should not be changed. Which rate is 9.04%?
No, that is what part 2 of the question. Part 3 saying residual value which will make the firm
Part 3 from part 2 interest or?
No, original only, 10 only. Because we have already made them indifferent, so then residual value will not undergo a change. We have already made them indifferent at a 9.04% interest. Now they are saying interest rate can't be changed. Can we change residual value and make us indifferent? So how do we do this? Residual value change. Residual value which will make the firm indifferent to the loan option with lease rental of 1,20,000.
The formula known as salvage value and writing the.
One is removing the salvage value of 35,000 and writing it as X and then doing the calculation again, which will take a longer time. So instead of doing that, now write calculation of indifferent residual value. Calculation of indifferent residual value. Calculation of indifferent residual value. Particulars and amount.
One of your homework questions in this pattern, one of the best questions is May 2016, appearing in page 60. May 2016.
Okay. Now listen for 2-3 minutes and then you guys complete it. My today's present value of loan option is 343,807. Lease option is 335,388. Now I have to reduce the loan option, and that is through which item? Salvage value. I have to reduce the loan option through salvage value. So required increase in salvage value. If my salvage value goes up by this, if the salvage value goes up by this amount, my present value of loan option can come down. Required increase in salvage value without adjustment for time value of money. Net increase is 8420. Real increase in salvage value is 8420 divided by the fifth year factor 12,371. Listen for some time, listen. So my salvage value instead of 35,000 being written there, if this number instead of 30,000, if this was 47,371, extra 12,371, my job would have been done. 335,388. Instead of 35,000, if I can make it 47,371, the job is over. I'll get 335,388. Now wait. Sorry, all these are NSV. Final salvage value is this 12,371 plus 35,000 divided by 0.7. Why 0.7 is when we had a salvage value of 50,000, we wrote only 35,000 because tax took away 30% of it because the asset is fully depreciated. So 50,000 gave us 35,000. Net my salvage value has to move to 67,673. When salvage value moves to 67,673, I'll get 70% of that, which is going to be 47,371. That 47,371 will help me in reducing the present value of loan option. I'll explain again. Loan option is this much, 343. Lease is 335. So my salvage value has to move up by 8420. That is without considering the time value of money impact. Once I consider that, it has to move up by 12,371, and that 12,371. So required NSV. NSV is 45,000 plus 12,371. Just a minute. Yeah, tell me.
Present value loan option 343,807. That is after considering tax.
Yes, correct.
Yeah, so when we are taking the lease option after considering tax, why are we computing the salvage value before tax?
So salvage value I am not computing before tax. Salvage value has a calculation, NSV, which you missed it in the last class. So NSV, when you calculate, you have sale value less book value, gain or loss, tax paid or tax saved, and net salvage value. So in this case, my asset is already fully depreciated. When asset is fully depreciated, if you sell the asset for 50,000, you get only 35,000 of salvage value. So that after tax figure is 35,000. So I was getting 35,000. Now first I have to move that 35,000 to 47,371. To move that to 47,371, you should have a salvage value of 67,673. NSV is 47,371, but what is asked is what is the residual value, so I should sell, because currently I am selling for 50,000 and I cannot say that you sell it for 47,371. You will have to end up selling it at 67,673. So the calculation is this much is the loan option, lease is already known, I need an increase of so much, so salvage value has to move up by so much. NSV will be this, and final salvage value is 67,673. If I have 67,673, this place instead of 35,000 I can write for 67,673 into 0.7. Why into 0.7 is you pay tax of 30% and you get 335,388. So do this. Indifferent residual value.
Manufacturing expenses. Will it be fixed? Will it be fixed? No. Office expenses. Yes. Advertising. No. Selling expenses, they themselves are given. Commission of sales. No. Carriage of selling expenses 20,000, total 60,000, total package charges 60,000, total package charges 60,000, less include package charges 60,000 minus 4,000, include package charges 60,000 minus 4,000 is 10,000. Are we clear? Yeah. The question has given a net profit of 30,000. The question has given a net profit of 30,000. I will reduce 2,000 from it. On the credit side, you find interest from security. On the debit side, you find.
Then tell me, how will you do the last part after completing this? Let me know what are we going to do the last part. Complete this and then let me know what.
Okay, it cannot be treated as an operational income at all. It cannot be treated as an interest income at all. You understand me? Okay, so that 2,000 anyhow you will get it. Because that is what the government said for you. That 2,000 will never get affected at all because that is for the deposit you have made. So in the next working note, revised net profit is equal to revised net profit is equal to 30,000 minus
Final salvage value will be real increase plus required investment.
Real increase?
Plus required investment. Final salvage value.
Final salvage value is required NSV divided by 70%.
interest on investment.
NSV by 70% or this real increase you see no, divide this by 70%, 50,000 plus this amount. At a NSV level you want an increase of 12,371.
At a gross level, I have to take.
So at a NSV level I need an increase of 12,371. At a salvage value I need an increase of 17,672. So 70 divided by 70%. At an NSV level increase is only 12,371. At a salvage value you will need an increase of 17,673.
Irrespective of the subject, that income will accrue to the middle. That income.
Now tell me, how do we do the last part?
So that 2,000
Last part.
into account. The company will come to you or we.
They want us to change the initial cost payable.
Am I so far clear to you? Am I so far clear to you?
Initial cost payable, which will make the firm indifferent to the loan option.
Third working note which I am taking of you. Can you find the annual turnover? Annual turnover means annual
Initial
turnover
cost
means
payable is your
turnover of
5 lakh of loan. So loan. So they are saying, tell me what should the loan be? 4 lakh, 3 lakh, 2 lakh. How do we answer that?
1st May 2017. So I want the turnover of
Will be that so my total lease annual installment is 1,20,000.
Installment is
1,20,000.
lease.
I want the
That is lease.
turnover of 1st May 2017.
Basically, they are saying you are continuing with that 3. Your lease rental value is 335, 388. Loan value is 343, 807. Tell me, how can I bring it down is what they are saying. Bring it down to 335, 388. Then only we are indifferent. I'll be indifferent if both the values are same. This is what you have done to calculate 343, 807. This 343, 807 has to be changed to 335, 388. That was through residual value. First we did it through interest rate, second we did it through residual value. Now third they want us to do it through initial cost.
So I have a turnover of 1 to 5 years is 84,000 cash flow.
Which one 84? That is okay, lease rental is done. We need not worry about lease rental. Lease rental, this is the value. 335, 388.
So we have to bring the loan amount to 335.
That's the requirement. See, we did first through interest rate fall. Second, we have done it through residual value. Now, third, we have to do it through initial cost. Installment amount? No. You went in the right direction, but not PVAF and all will not come.
Okay, so this is the other table, sir. Like in year 1 to 5, we have a net cash flow.
Hmm.
And we have present value of all the 5 years.
ठीक है.
Profit in that, the total of DCF of that should be taken as 343.
Where? That is I understood. So I want this number to be 335, 388.
Yes, sir. So
For that to change, obviously you have to change this.
we assume principal is X.
No, okay. My principal is 0.2x. My cost of the asset is x. Initial cost they want to change. So please listen for 2 minutes and you do it. Principal is 0.2x for all the 5 years. Principal is 0.2x for all the 5 years. So let me do it parallelly. Just
Because it's equal payment.
equal payment.
My dear friends, January to April, the business was happening in the normal manner. You all agree, right? Okay.
See, principal every year is going to be 0.2x.
April 2006.
Interest is, what is the interest rate? 10%. So 0.1x for the first year. Second year is 0.8x. Sorry, 0.08x. Why 0.8x is 80% is spending. Initially 1 lakh x rupees is spending, then 0.8x is spending. Then it becomes 0.06x, 0.04x and 0.02x. Depreciation every year is going to be 0.2x. You can calculate the tax benefit on this. Salvage value will be 35,000. That doesn't undergo a change. You will get your NCF in terms of x. You will get this figure and equate this figure to 335, 388. So my principal is 0.2x every year. Interest is 0.1x, 0.08x, 0.06, 0.04, 0.02. Depreciation is 0.2x every year. So calculate the tax benefit, get the NCF and then let me know what equates to 335, 388. So right, let us assume the initial cost to be x. Let us assume the initial cost to be x. Initial cost to be x.
30,000 divided by 150 is 20%. And the percentage, 30,000
Now please do
divided
this.
by 150, 20%. You agree with me?
The format is the same. This figure has to match to 335, 388. We are trying to reduce it through different routes. This will make it very clear on the indifference analysis part.
My dear friends, what are all the things this question made me to find out? They have not directly given what is the standing charges, but I know the definition of standing charges, which is fixed expenses. In this question, I found out 60,000 as fixed expenses to the extent of 4,000 uninsured, so 56,000 insured standing charge.
This you will equate to 335, 380. So answer is 335, 380 plus salvage value divided by this number. 4,88,000 something. This much I can spend on the cost of the asset. 4,88,538 is what I can spend on the cost of the asset. For the cost of the asset, we can end up paying 4,88,538.